Hey, everybody, welcome to the January 2026 market update. Let's go ahead and dive right in. January was kind of an interesting month to look at. If you're new with us, I look at a 5-county area, including Wake, Durham, Johnston, Orange, and Chatham counties. Now, if you remember back to the fourth quarter of last year, in real time, the market felt really tough. It felt really tight. Stuff wasn't moving, showings, listings weren't getting showings. But if you remember the videos, I talked about some underlying data that was really pointing to the market strengthening and us leading into 2026 with a lot of good opportunity. The market had turned by the midpoint last year to where we surpassed 2024 in terms of closings. Interest rates were starting to moderate in a really healthy, sustainable way. Affordability was improving. Wages were up. Inflation was moderating and showing activity was increasing. These are all things that point to as leading indicators that there was some good times potentially ahead. Was never expecting or predicting a spike up in 2026 in terms of sales activity, but a return to normalcy and a return to balance. So 2026 has some interesting things, but let's just jump into it real quick. New listings actually were down 4.6%. Closed sales were down 9.3%. One thing to remember if you were here locally is that we had two different winter weather events, an ice storm and a snowstorm. And inevitably, that is going to slow down the process of new listings hitting the market. So that likely had an impact, maybe a significant impact on the number of new listings that came on in January. We'll find out as we look back into February if some of those listings just got kicked down the road and we see an increase in new listings in February. Now, the winter weather typically doesn't have a huge impact on closed sales. Most of those closed sales that were going to happen in January did happen. So that's just a product of sometimes in January, we'll see closed sales go down. What I'll also say is that in January of 2025, we saw a really healthy increase in new listings and closed sales year over year. So the bar was just a little bit higher, but I'm not going to lie. I was hopeful that in January we would see actually an improvement year over year in both new listings and closed sales. I can wash away the new listings because of the winter weather. Closed sales, I don't really have a great explanation for other than it is just a moment in time. It's just a blip on the radar. We will continue to monitor this as the year goes on. I'm still fully confident that we will see a continued upward trajectory in terms of closed sales into 2026. Median price was actually down 3% in January year over year. So that's compared to last January, not compared to December. At 426% of list price, still negotiable out there in the market. We're looking at about a 98% list price to sell price ratio. And then again, another really positive sign is that total showing activity was up 3.2% year over year, over 29,000 showings in this 5-county area. That's a great leading indicator. Buyers are out there. They're not just kicking tires. They are looking for homes. So if we can get the new listing inventory to continue going up, we have buyers out there looking to purchase, and that's going to be a great environment to create churn in our market in a healthy way, and that's what we're looking for. Inventory was up 16.1%. Now, when I talk about inventory, that's different from new listings. New listings is houses that were put on the market in January. Inventory is a point in time every month that is checked to say how many houses are for sale at this moment. It was up 16% year over year. If you've been watching these videos, I've been talking about the fact that a year ago now, 18 months ago now, we saw inventory levels going up by 50, 60%. And there were these great opportunities for the media to talk about a spike, a surge in inventory and how the market's crashing because the year over year percentage was so high. But as I've been telling you for a year now, as we got into 2026, we were going to see those eye-popping numbers come down, not because inventory itself is actually changing, but just the year-over-year metrics are changing. We're coming off such a starved inventory environment that it was normal to see the percentages be so high. So now we're getting back into something that's more healthy, more normal, and it's reflected here. 16% year-over-year increase, just under 6,000 homes for sale. Month supply of inventory in January, 4.3. That seems higher than what we have seen if you watch these every month. But that's also normal in January. January is just an oddity in that you always have less closings because you have less people looking to go under contract in December. Most people are trying to close in December. And then not a lot of people are putting their house on the market in December. They wait until January. So you always see this fall off in closings and increase in new listings from December to January. And it creates this kind of environment where you can get a high supply of inventory. I think it's misleading. That doesn't necessarily really represent what our inventory environment looks like. But even if it did, 4 to 6 months is a balanced market. I would take that and be happy all day long. Now, as I always do, I like to look back at the last time we had a, quote, normal market, and that would be January 2019. And I say normal because that's pre-COVID. So let's look at what the numbers were in January 2019 to give us some context, so we know what are the numbers that are happening today, what does that actually look like juxtaposed to a, quote, normal market. Inventory back in 2019 was over 7,500. We're just at 6,000. So we still have lots of runway to go just to get back to where we were in 2019. And if you were selling real estate in 2019, you know we didn't have any inventory back then. You couldn't find houses for your buyers. So just to get back, we have a long way to go to that level and plenty of room to go beyond that to where we would still have a really healthy inventory level in our market. Month supply back then, 4.4, again, right where we are now. Now, here's the interesting thing. Median sales price back then, 2019, was $278,000. What I like to do is take that price, and let's say that we never had the spike in prices that we saw during COVID in 2020 and 2021. What if we just had straight line appreciation at 5.5%, which would be considered a normal, healthy appreciation in our market here in the Raleigh metro area and the Triangle area of North Carolina? What would that look like? And if we applied that for the last 7 years, prices today would be at about $404,000. Well, again, right now we're at $426,000. That's still a decent little gap there, but it's actually only about 5%. So if you've been watching these videos, you know this gap has been much bigger for much longer. And now we're starting to bridge that gap. What that means in a practical sense is that consumers now are starting to look at a house that they could buy for $400,000 and say, you know what, that feels like a $400,000 house. Whereas 2 or 3 years ago, they would say, I can't believe I have to spend $400,000 to get this house. So this sentiment is changing to where consumers start to feel like they're getting what they're paying for. So the numbers show it here on paper. And anecdotally, I can tell you from talking to our agents, that's the sentiment out there in the real world as well. Now, if prices stay flat this year, which in 2025, the median price was flat for this 5-county area, if that can happen again this year, if I'm doing this video next January and telling you that prices were flat, now we have crossed paths again. The line has crossed on the chart, and now prices are exactly where they would have been if we didn't have the increases during COVID. So I'm really optimistic about what that means for consumer sentiment and how consumers view value for what they're buying. Now let's just look. New listings in 2019, just under 3,100, just over 2,600 this year. Closed sales just over 1,700, just under 1,400 this year. That doesn't mean a lot in a 1-month snapshot. We will continue to monitor those year-to-date numbers. Again, I do not expect that we will surpass 2019 in terms of closed sales for the year. We have a long way to go. I'll show you that in just a second. But I do expect that we will surpass the 2025 numbers. This is just a store of inventory for me, or of data for me. Let's look real quick at inventory levels. I got this lonely little green dot here. This represents January. We will continue to watch this. But again, we are ahead of where we were in 2025, just for January. We will watch this, and hopefully we will see this trend line exist in between these two, this orange and blue line representing 2019. Hey, it'd be great if we could get up above it. I don't anticipate that happening this year. But we'll continue to watch that. Now let's take a look at new listings. This green bar, this is 2026. Orange is 2025. Blue is 2019. It's hard to see on your screen. Maybe you can zoom in. And we have a percentage over the orange and the green bar chart. And all this represents how much, what percentage of increase in new listings we would need to catch up to 2019 numbers. And so this is 16.9%. Again, this is just year-to-date numbers, but it's only 1 month. So as this continues on, what we're hoping to see is the green bar surpass the orange bar and then continue to bridge the gap. So just gives you a frame of reference here. Again, when you're looking at 1 month, it doesn't mean a whole lot. Looking at closed sales, same thing. I show you this monthly data just so you can kind of see what is a typical trend line to make sure that we're staying in line with what is historically normal in our market. Again, we were behind where we were last year. in 2025, we actually started the year in January ahead of where we were in 2024. So kind of an opposite thing here, but then sales fell off and didn't climb at the rate that we were hoping they would. So hopefully that's the inverse of this year, a slower start in January, but I'm expecting a ramp up. So we should see both monthly increases here over 2025. And when we look at the year-to-date numbers, we should see that surpass 2025. Last year, it took us through July, until July, to finally surpass the 2024 numbers. Hopefully we can surpass before July. That would mean we have a very healthy spring market. That's what we're looking for. So again, right now we're 22.6% below where we need to be to catch up to 2019 numbers in terms of closed sales. So hopefully within the next couple of years, we can actually surpass that line for 2019. But we'll just be watching this closely as we go through the year. New listing to closing ratio, nothing to see here. When we have 1 month's worth of data, it's worthless, doesn't mean anything. But think of this ratio as how painful does it feel to be a seller in the market. So when you go back to the financial crisis, you had to list 2 houses to sell 1. So 50% of the listings weren't going to sell. And then you can see how it improved over time up until we got to the COVID market. And basically every single house that got listed sold. You remember that? You know that to be true. Last year we ended at 1.37. So think every 4 houses that get listed, 3 of them sold. That's actually probably a really healthy place to be. Now, if there's not a lot of churn in the market, meaning there's just not a lot of transactions happening, it can be really painful to be a real estate agent in that environment. Because if you're just not taking as many listings when one of them doesn't sell, it feels really painful. But as far as a seller goes, of course, you want your house to sell, but I would say 3 out of 4 selling is probably a pretty healthy place to be. Not terrible anyway. So we'll see where 2026 lands. I am expecting it to be equal to or better than where we were in 2025. Now, perhaps the best news, and certainly the best news, and just another glaring indicator that there's a good opportunity for things to improve in 2026, that is housing affordability. That is at 97. This is the highest that it's been in 4 years. August 2019, we're at 140. We haven't been over 100 since March 2022. So it's been a long time that we've had really painful affordability, but think of this as prices have stayed moderated, mortgage rates have come down, inflation has moderated, wages are up, and this leads to affordability. This is the number that for as long as I've been doing these videos, I've told you, if you want to know how the real estate market is doing, look at this number. And so this is a great leading indicator. Housing is affordable, and I can assure you in the Raleigh metro market, when housing is affordable, people are going to be buying it. So I see a lot of signs that 2026 is shaping up to be a stronger year than 2025. Don't get me wrong. I'm not predicting by any stretch, nor do I want that the market goes back to a COVID type panicked market. I don't think we're going to see that at all, but we do need to see more inventory coming onto the market to sustain all of these positive trends that we're seeing. So really, I think good news, kind of some odd numbers, some odd data that we see in January in terms of new listings and closed sales. But I think it's just going to be a blip on the radar as we watch the year-to-date numbers continue throughout the year. I think we're going to see some really good trajectories. I'm excited for the buyers out there who now finally can afford housing again. I'm excited for the sellers. There's a healthy market out there. There should be good churn for you. And I'm excited for real estate agents. It's a great opportunity to get out there and help your consumers, help your clients find success in real estate. So pumped for everybody involved. Continue watching, subscribe to our channel if you want to see the videos we're putting out. And hopefully this information has been helpful. Thanks, everybody.